Hey guys, this is Abhinesh from Hedge Fund 2020. Today I wanted to talk about what the fork is volatility. Everybody wants to talk about it. Every news channel covers about it. So I thought I would throw a quick video for you guys to cover what volatility actually is. So I picked up Google or I typed into Google, okay, tell me what volatility is. Okay, so this is what came up. According to Investopedia, volatility is a statistical measure of the dispersion returns for a given security. Hmm. Volatility can be measured by using the standard deviation or variance between returns. Okay. About this point, I was feeling really overwhelmed. I know a little bit of statistics, but um, it's kind of a lot to digest. So I thought I would make it simpler. Okay. The way I think about volatility to me is how the stock market or the individual stock moves and not necessarily how much the stock market or an individual stock moves over a period of time. Okay, so if you see here, I put a high volatility stock together where it starts at 10 and ends at 20, but there are huge price swings in the middle. Okay, it starts at 10 and then goes to 5 and then bounces back and forth before it gets to 20. So that's high volatility stock. Now let's talk about low volatility stock. Okay, it starts at 5, slowly graduates to 7, 10, 15, and 20 over a period of time. So both stocks move from 10 to 20, but the low volatility stocks, the trend is a lot more smoother with less price swings. So that is what a low volatility stock is to me. Okay, so the price is in a gradual trend. There's not huge price swings, and to that, um, the less the price swings are, the lower the volatility. The higher the price swings are, the higher the volatility. Okay. Hopefully that definition makes it a little bit simpler for you guys to understand. Um, Now moving on, okay? So the other thing I wanted to cover is why is volatility so important, okay? So sudden spike in volatility can occur, and this might be due to good news or extremely negative news about the stock market or the stock itself, okay? It could be a huge buying opportunity or could be the time to cut your losses and move on. Either way, volatility could be a useful indicator to determine the timing of your investment or the type of your investment. Okay. Now, there are some stocks that are more volatile than the others. Why? Because these are stocks that are in growth mode. Okay. There are stocks that are in their growing phase. For example, like stocks that are new technology stocks. They are trying to figure things out. They're trying to put their business plan together. They're trying to start make revenue. They're trying to capture market share. Whereas compared to the old technology stocks, they already know what business they are in. They already know how to monetize from their people. They're actually slowly, steadily cranking profits every quarter. Okay, so for the same reason, Tesla, which is a new technology stock, is more volatile than GM. And Amazon, which is also a new technology stock, they are adventurous. They want to be investing in a lot of new trends. They are a lot more volatile compared to Walmart. Okay, so depending upon how you want your investment to grow, or how do you want your investment to behave, right? You might want to choose to invest in a low volatile stock or a high volatile stock, okay? High volatile stock have the potential to give you a significantly higher returns, but they're also very risky compared to the low volatility stocks. So everybody, when they talk about volatility, volatility means higher risk. You are taking the risk in exchange for high returns, okay? I want to highlight that here. Okay, can the volatility of a stock change over time? Of course. So how does it change? For the one reason it changes is because you have positive news or events with regards to the stock or the stock market. Okay, Twitter is a really good example of how A highly volatile stock is now a little bit less volatile. Why? Because they finally figured out how to monetize and keep their followers coming back to the platform. Okay, so Twitter has been really good for this year of 2018, but for the last year, a lot of people were saying negative things about it. People don't want to buy it, but this year it's one of the hottest stock in the market, and it's been slowly and steadily growing every day. Okay, Twitter volatility has come down in 2018 compared to 2017. The other one I wanted to point out is Crocs. Crocs is your shoe company with a lot of holes. Some people love it, some people hate it, but the stock itself was a $7 stock as of 2017. Right now, it's a $16 stock. Okay, so and if you see the trend, it's been smooth. It's been so much less volatility compared to other new technology companies. And of course, Crocs are the only greatest and the most stylish shoe known to man. I am kidding. Okay, so it's one of those stocks where it's been slowly and steadily cranking profits and it's low volatility and it's been giving decent returns, okay? Now let's go to the negative news or events. This is how a stock becomes more volatile compared to the history, okay? So let's take an example of Wells Fargo. Wells Fargo is, a bank. It's a mortgage company. It's been in the business forever. It knows how to generate revenue. But they were slapped with $1 billion fine because of their bad sales practices, and that made the stock more volatile. Okay. And another good example of a volatile stock is Tesla. Tesla has always been volatile, but recently it's been more volatile because of the earnings not coming as expected. Facebook. Facebook is one of those giants. It's almost monopolized the social media market, but it did take a beating because Mark Zuckerberg had to show up in front of Congress to make sure that his business is still good. So it bounced back right away, but it did make the stock more volatile. Okay. Anytime there's news coming about the stock, especially negative news, it increases the volatility of the stock. Now, how do you measure volatility? Okay, volatility of the S&P 500 index, which is the index that tracks the 500 biggest companies all put together, and it's also called one of the benchmark indexes for the US stock market, is measured by another index called VIX. VIX. This measures the volatility of the whole S&P 500 and hence the whole stock market as a whole. Okay. The good news is VIX is pre-calculated for you. You don't have to do the standard deviation. You don't have to do the math. They do it for you. Okay. Here's where you can find it. You go to cboe.com/VIX and then you get all the data you want about VIX and you can see how volatile the stock market is as of today. Okay. Now, I did also want to mention that VIX is also called the fear index. Okay, why? Because it measures how fearful of the stock market people are. Are people buying stocks or are they dumping stocks? If they are, how aggressively are they buying or selling stocks? Okay, high VIX volatility index means people are aggressively selling. Okay. At the same time, the VIX, when it drops from being super high to low, that's when people are aggressively buying. Okay. Now, I did put a chart together that shows you VIX all the way from the 1990s to today. Okay. I pointed out a huge spike in there. Can you guess what it was? Yes, you did it. It was the 2008 financial crisis. Okay. This is when people were super fearful about the market. Nobody wanted to be in the market. Everybody wanted to take money out. And guess what happened? VIX went through the roof. Okay. This could have been a huge buying opportunity for you if you had seen that the VIX went all the way up and then started coming down, right? So volatility is a good indicator of how fearful of the stock market people are and when are they willing to go in and buy stocks. Okay, how now we've talked about how you can measure the volatility of the S&P 500, which is the entire stock market as a whole, but let's talk about how do you measure volatility for an individual stock. Okay, Again, there's the scientific way of doing it, which is finding the standard deviation of the past prices and figuring out if the stock is volatile or not. If you don't want to do all that, there is sort of a common sense approach to tell you if the stock is volatile or not. The way I found it is what I do is I pull up the chart for a stock and then I draw the 100-day moving average, okay? And I see in the last year how many times the stock has crossed back and forth over the 100-day moving average. It is not scientific, but it works, guys. Okay. So, first of all, what is a 100-day moving average? Okay. To simply explain, it is the rolling average price of the stock over the last 100 days. And the window keeps moving. That's why it's called a moving average, okay? So today it calculates the average price for the last 100 days, and tomorrow it calculates the average price of today and the 99 days before it. And the window keeps moving as the day keeps moving, okay? The good news again on this is one of a default setting that you can find in Yahoo Finance or any other trading platform that you prefer, okay? So I wanted to pull up the stock of Tesla to see, okay, let me see how the stock moved against its 100-day moving average, okay? Here's a quick show. So the Tesla stock moved back and forth over the 100-day moving average 8 times, guys. 8 times, okay? Is that volatile? Let's take a look. This is the chart of Microsoft, okay? This is the chart of Microsoft. The blue line again is the 100-day moving average, and the Microsoft stock moved across the 100-day moving average once in the last year. Here's Tesla. The blue line is the 100-day moving average. It crossed 8 times. Here's Microsoft. It crossed against the 100-day moving average once. Okay. Now, Tesla is more volatile than Microsoft, but Tesla might be 4 times, 5 times bigger because they only captured portion of the car industry right now, right? Microsoft, it's not going to be 4 times or 5 times as big in the next few years. But Tesla is more risky, whereas Microsoft is less risky because they are slowly cranking out profits, right? So again, it's your personal choice, but you have to consider the volatility of the stock itself before you invest, okay? Now, here's how you do the 100-day moving average in Yahoo Finance, okay? You pull up the stock, whichever one you want, and then in the left corner of the chart, there is one called indicators. You click on it, and then you click on moving average. And then this box pops up. Instead of where it says 50, now you put 100, and then bam. That's your 100-day moving average, guys. And then you can go look at any stock you want, see how many times it crossed the 100-day moving average over the last year or so, and then you can determine for yourself, is the stock volatile or not? Do I want to invest in the stock or not? Okay. Now, there's a couple of things that I did not cover about volatility, okay? One is implied volatility and historical volatility. Both these are pertinent to advanced trading, which is options trading, okay? So far, the volatility I've covered is about stock market trading. You buy stocks, sell stocks. It is an important indicator for you to make decisions to understand how volatile your investment is going to be, okay? Now, I wanted to throw out this book out there, okay? I've been investing trading over the last 5 years, but I've only started making money over the last 2 years. Why? I had to do a lot of homework, read a lot of books, and this is one of those books that is recommended by every hedge fund manager that's out there, okay? It's called Market Wizards, and it's by Jack Schwager. He's got 3 different books, really, really highly rated books, and you ought to read it. If you want to know more about the stock market, if you want to know more about trading or investing, you got to read it. Okay. Now, I am not a physical book person. Okay. I like ebooks, I like audiobooks. Okay. And I own this book both in the ebook version and in the audiobook version. And an added bonus, I've added 2 links in the description of the video below that gives the Amazon Kindle, which is the ebook service of Amazon, a month free for you. Okay, it's a free month if you click on the link and sign up for Amazon Kindle, or if you want the audio version of the book, You get 2 audiobooks free when you start your trial with Amazon Audible. Okay. I love the audio version of the book. You listen to it when you're in your car, in your plane, wherever you go. But guess what? You get it for free. You buy the Market Wizards book 2 out of 3 for free, and then you get to enjoy the book, learn more about the stock market, and then get better at investing or trading. Okay. All right, guys, that's all I had for this week. Thank you so much for watching this video. Hopefully you got a lot out of this. Please, if you have any questions, please leave it in the comment section below. I will make sure to answer your questions. Thank you. Happy trading, happy investing. Peace, guys.